I'm Matt Fox. I'm the CEO of SpotGamma. Today's discussion is led by our founder, Brent Kochuba, as we show you how Vanna plays a key role in determining your trading returns. This matters whether you're an options trader, equities trader, or futures trader. The importance of Vanna is something that can't be understated. And we're going to unpack that for you today. Great. So that was the risk page. So again, everything we're giving you is educational. Can you go back 2 slides, please, Brent? Beyond risk.
This way. There we go.
There we go. Okay. Brent hates pictures of himself. All right. So first, before we dive in, if you're new to SpotGamma, just quickly, Brent founded SpotGamma in 2020 to unveil how the options market drives prices across stocks, futures, and even the largest US indices. Over the past 5 years, we provided our insights to international publications such as the Wall Street Journal, Bloomberg, and Reuters, contributed to key academic white papers with Columbia University, and advised global governmental agencies around the risks associated with options trading. And most importantly, deliver knowledge and proprietary content to our trading community. And now let's turn our attention to Vanna.
Brent and Vanna. All right.
Well, 1 second. I have one more. In today's discussion, we will break down this buzzword Vanna that you may have heard but not really understood exactly what it means. So we're going to be walking through what is Vanna, definitionally, making sure you really have a grounding. Then we're going to get into some case studies, kind of going through different light examples of applications of volatility in Vanna. And then we'll show the impact that Vanna even has on the largest US indices. And now, Brent.
Cool. Thanks so much, Matt. Thank you all for coming along today. Excited to talk about this topic of Vanna. It is obviously, as Matt said, one of the biggest buzzwords there is at the moment in the options landscape. And so we want to just put some context around it, tell you all what it is, how it can help you as a trader. And before we got into that topic, this chart or similar chart came across from the Marketeer, the folks at the Marketeer, good friends of ours. And it is the somewhat unrelated to Vanna, but what makes it so fascinating to me is this is the NVIDIA 785 call, which was the at the money call from yesterday. This was the value of the call going into earnings, and the stock was 15% lower into earnings. And then because of the earnings implied vol crush, the stock went up 15%. And if you had that call, you're basically only about break even. And so I wanted to include this chart, and I literally threw it in as we were clicking the go button here today, because it just really encompasses why, as individual stock traders, we need to be so aware of the changes of implied volatility for expressing our own trades. But it also really highlights how the changes of implied volatility can change hedging flows. And that is really why we care about Vanna. It is the ability to monitor what dealers and market makers may do, or how traders may adjust underlying hedges. And that's what's so critical here when we get into this topic. So let's drill down a little bit more into that. Why does it matter? On your chart here it's a plot of a put option. This is just a value of an 80 strike put option. So it's an out of the money put. And all I did was change implied volatility for this option. So you can see here the darker green line, I shifted implied vol up 30%. And what that does is it increases the value of the put option significantly. As you can see here on the y-axis, that's the value of the put. So if all you did, if the stock in this case stayed at, let's just say 82 bucks, and vol just went boom, jacked up, all of a sudden your price or the value of your option would jump up significantly. Now, obviously in the NVIDIA case I just showed, it worked the other way, where vol came down, right? And the value of your call in that case got crushed. But this implied volatility concept, not only does it shift the value again of a put in this case, or the call in the case I just showed, but you can imagine that if the value of calls and puts are expanding and contracting with volatility, that means that the hedging flow associated with those calls and puts is also going to shift as well. And so we will move a little bit in. Scott says it didn't do anything to a 600 put. Good for you on that one. All right, so why is Vanna so important? Let's talk about A through D here. Number one, we got to talk about delta. Most hedging flows that we talk about fall into 2 buckets. That's delta or vega. We're really going to talk about delta in this case, and what it is. Make sure we're all on the same page. That allows us to define Vanna. We're going to talk about implied volatility, and then we're going to move a little bit further into some pricing models. So number one, delta is the most critical Greek. I know many of you on this webinar here today are aware of what delta is, but I want to make sure we're talking about it in the same frame. There's a couple of different definitions. So delta, you could say, is the change of an option's value for $1 change in the underlying asset's price. But you can also see it as a hedge ratio. So if an option value is delta is 50 and a stock goes up $1, well, you can have 50 shares of stock that will hedge you out for that $1 move. And so we want to think of it, and we're going to frame delta for purposes of this conversation as given an underlying stock price, volatility level, and how much time to expiration. Let's say those are all fixed. I need X shares to hedge this option right now. So that is what we're referring to as delta. So we're all on the same page. Again, how many shares do I need to hedge out the price risk of my option position? So what is Vanna? I don't want to read this entire slide here. That's why I put a little camera icon on the top right, so you can grab a screenshot of this if you want. But essentially what Vanna is, it measures the change in delta for a change in implied volatility. So as implied volatility shifts, Vanna tells us how much delta of an option or a portfolio options is going to change in kind. Now that is how we're going to frame Vanna anytime we refer to it in this presentation. That's basically what we're going to be talking to or talking about. Again, as Matt said before, this will be recorded, so you all have the ability to go back in this presentation as well. Now, let's set the last piece here, and that is implied volatility. Implied volatility is the forecast of a likely movement in an asset's price. And what's critical about this is it's the traders, or it is the market forecast, right? It's the trader's forecast of the movement of an asset's price. Implied volatility, if you caught us on recent discussions, implied volatility is subjective to sort of the eye of the beholder. You can think that implied volatility may be set to increase or decrease, but there's nothing concrete about it. You can obviously make a concrete assumption about what the strike price of an option is or how much time to expiration is, right? Those are fixed. We're all going to agree on that, but volatility is up for discussion in some ways. And so when we also quote implied volatility, or if we say vol or anything like that, it's generally quoted on an annualized basis. And the annualized figure, the reason we quote it in annualized terms is because it allows for simplification some of the models that are used, like Black-Scholes, and it also allows us to compare kind of apples to apples, excuse me, not just across stocks, but also different asset classes. So if you want to see what is Bitcoin, for example, average volatility, if you know that's annualized, then you can compare it to annualized S&P volatility, and you're on the same expected time frame. So again, grab a screenshot of that. So how do we generally get the implied vols and or Greeks from, or that we're all watching on a daily basis? In this case here, we're looking at essentially the Black-Scholes model, which is the most well-known options models. And what we're doing here is we pop in a bunch of model inputs like the stock price, strike price, time to expiration. Those are metrics that we can all agree on, and out of those models comes the implied volatility in the Greeks. We've talked about before that if you are a liquidity provider, dealer or market maker, you're generally not talking in options bid or offer terms. You're talking about implied volatility terms yourself. So you are pricing things off of an implied volatility level that generates a bid or offer. In this case, for most of us that are on the buy side, retail, whatever it may be, people like myself, we are looking at the output and saying, okay, the market is pricing in based on these Black-Scholes outputs, an implied vol of, let's say, 20%, and then my delta is this, and my vega is this, et cetera, et cetera. So that is how these metrics are all priced. We're going to get into a lot of this in future webinars. So if any of this is a little bit confusing, rest assured we have more resources coming up for all of you. Okay, so how does hedging Vanna work, or how does hedging with Vanna work? Essentially, what we're saying here is giving the implied volatility move, I will need to adjust my option hedge, i.e. my delta, by X shares. And so if your book is long calls and or short puts, if implied vol is going up, you need to sell stock. Vice versa, if implied vol is going down, you need to buy stock. And then it's the reverse, obviously, when we say we're short calls and long puts. Historically speaking, we see the S&P index traders or market makers, we should say, as short calls and long puts. That's sort of the default stance that we think about when we're talking about S&P 500 options positioning. And so when you flip around some of these metrics and say, okay, more people are selling puts, obviously that changes some of these dynamics as well. So when you have a portfolio of options, obviously you got to blend a lot of this sort of stuff together. But if you just look at these snapshot metrics, that's how you're adjusting your deltas when we change implied volatility. So let's take a look at exactly how this works. Now, we have a call on the left and a put on the right. The main difference here is that the deltas are going to be flipped around. But essentially what you can see is that we have a single option here, and all we did was we adjusted the implied volatility, and then we plotted out what the relevant delta would be. So what you can see is that the impact of changes of implied volatility is biggest for options that are slightly out of the money. So this is let's say 100 strike option. When you're 5% to 10% out of the money or in the money, depending on which way you're looking at it, you could see that the impact of implied volatility changes on delta changes quite a bit, right? And so if you have, for example, that slightly out of the money NVIDIA call and vol gets crushed, well, that delta of that option is going to get crushed. Same thing that works when the market is kind of really crashing, right? And like the VIX is up 50 and vol is really moving. As soon as that vol changes, the value of those puts changes immensely as well. And that changes the delta flows and can shift around the way that the market is trading. And so you can start to see, again, what are the impacts of this? And when you extrapolate or expand this idea across not just one option, but the entire options complex, you could see why, kind of like a waves crashing on the shore, so to speak, you could see why the hedging flows would change around the expansion and contraction of implied volatility. So let's take a look at a case study here. In this case, I pulled up AMD. We had just sort of finalized some of our presentations here in the last couple of days, but NVIDIA is going to give us a lot of the same looks. So this is from mid-February. The chart you see on your screen here is from our implied volatility dashboard. These are a set of new tools we just built. And what you see in gray is the call skew, or the skew, excuse me, for about a 2-week option in AMD. That's what the 17 days to expiration denotes. And you'll note this shaded cone here. The shaded cone shows you the 9th to 10th percentile range for this particular expiration over the last several months. So what you see here is into earnings, there was an exceptionally high call skew in AMD. People were very excited, particularly back then. I know they've gotten even more pumped over the last day or two, but back to mid-February, people were very excited about the prospects of AMD really blowing out earnings and generating more upside returns. So when you see this call skew, what this tells you is that a out of the money call, so let's say a 10% call, that's what I've highlighted here, has a higher implied volatility than the at the money, so the 100% on this chart, or even a equivalent put. So in this case, this is the 90 percentile put. So what this call skew is telling us, when we say this is a high skew, high call skew, people are very bulled up on this option, right? Or bulled up on AMD calls just in general. So what this sets up is not only is this interesting in that we could tell there's excess call demand, we could tell because this skew is above this cone that it's kind of excessive in our view a little bit, right? Because we're well above the previous historical range, which is what this gray bar is. So what does this mean for all of us as traders, and what happens when earnings comes out? Again, this chart is from the day before earnings. Well, here's that gray line pre-earnings, and then what happens as soon as earnings comes out? This is essentially the next day. You see call skew, the call skew flattens, which means suddenly that 10% out of the money call is priced much more equivalent to the at the money or even the put, right? This line is very flat. And also there's just a general deflating of implied volatility. So if you pictured implied volatility as a surface or as a floor, that floor, just like a balloon letting the air out, just boom, the tide went out, vol comes down. And if you remember from some of our conversations or some of our slides just a few moments ago, when that call implied vol comes down, that starts to drain off some of that delta or the hedging requirements from dealers and market makers. So let's give an example of that. This was the implied volatility here in blue of a 190 strike call. So the stock was around 170, 175 into expiration, into earnings. So with 2 weeks, essentially 15 days to expiration, the delta of that 190 strike call with an implied volatility of 75% was roughly 30. That's what this blue box is indicating. If vol went up, let's say AMD just did this amazing thing and moved revenues by 200% and vol went up because of that, then the delta would have risen of that option would have gone up to about 40. But actually what happened is as soon as earnings comes out, delta the delta declines because the implied volatility goes down and delta declines. So again, after earnings, what happens? Vol comes down, as almost always happens. Vol comes down and the delta of these calls comes down in kind. The only stock I've seen in recent history where vol went up was ARM. That was the SoftBank semi stock. Vol actually went up after earnings. It was pretty remarkable. Almost always we see vol go down as earnings comes out. Vol comes down. In this case, the delta hedging requirement of options generally will come down as well. So what I did is to put some numbers behind all of this. I said, what is the open interest of this exact option? So in this case, there were 6,000 calls for the 2/16 expiration at this time. And so if you did the basic math and you said, okay, 6,000 calls at a 50 delta, and you multiply that out, the hedge ratio is roughly $57 million pre-earnings. So what happens is as soon as vol comes down, the delta of that option obviously is going to drop, right? Vol comes down, the delta comes down. And then not only that, the stock starts to drift a little bit lower. So whether you want to say hedging pressure would start to cause some selling in the stock, or the stock came down, which brought the vol down, either way, suddenly the dealers went from, on this particular strike, if these all were long calls, the dealers went from having $57 million of hedging flow on this single option down to $10 million. So just the function of the vol coming down is going to bring selling pressure. And if the stock starts to move down, then suddenly that selling pressure is going to persist because obviously these options are starting to lose value. So if you get, another way to think about this is we have these situations now where stocks are going up and vol is going up. If you watch the VIX, it's been pretty stable, even though the market's up substantially, right? VIX isn't coming down. Single stock vol is going up. So when a stock up, vol up environment, as soon as vol pauses or vol comes down, stocks are going to move down as well. It's a little bit inverse to how we're used to things, right? We're usually in a scenario where, hey, VIX is spiking as the market goes down. And if I was to tell you, hey, tomorrow the VIX goes to 50, you're probably going to tell me that the stock market's substantially lower, right? But in this environment, things are a little bit switched or flipped around. So why does this matter? This is part of the feedback loop, or a feedback loop, that we've talked about before. I'm sure everybody on this call's heard of the term reflexivity, which is something that, in terms of trading parlance, George Soros coined, about this idea that when flows start to kick in, they invoke more flows that cauterize or push the same behavior. So for example, if all of us start to buy stock, or whatever, oil or whatever it may be, that creates FOMO and that creates more buying. Now in option scenarios, what happens is, if as a stock gets very bullish and people pile into certain themes like AI is going to really save the world, right? That causes IV to increase. Implied volatility goes up. Well, as we showed in this slide here, when implied vol goes up, the delta of these options goes up, slightly out of the money calls. And so that means dealers and market makers have to buy more and more shares of stock, and that pushes the stock up even faster. And so what happens is then we get into these momentum-based trades where vol is going up as the stock is going up. People don't want to miss out. They continue to buy, and the feedback loop continues until something snaps that momentum, right? Oftentimes earnings is that event. We've documented with NVIDIA, for example, that after earnings, the stock oftentimes has a large period of consolidation because vol suddenly comes out. Vol gets crushed, like in that opening chart I posted of that 785 call. When vol gets crushed, the delta comes down of those calls, and dealers and market makers may be able to start selling some of that stock, which leads to a correction. I believe we just saw one of those corrections over last week as we entered VIX expiration and options expiration. We saw a lot of consolidation. It was a limited 3-day consolidation, but those vols all came in. Stocks came down. SMH was down, I think, 5% over a couple of days. And then obviously NVIDIA earnings reinvigorated everything. Now, the same thing happens in a downside scenario where we have the market is crashing. Think about it when the market is crashing. If dealers and market makers are selling puts, right? If we're buying puts, dealers and market makers are selling them. As the market is crashing, they need to sell futures to keep up. The VIX is going to 50, and the market just has this feedback loop because as the stock market goes lower, more and more shares of stock has to get sold to hedge. And then what happens is options expiration comes and puts are cleared out, or the Fed comes in and backstops the market and says something that suddenly snaps that feedback loop, breaks that reflexive feedback loop, and we see generally and oftentimes a very sharp reversal. So when you're what makes it so critical to watch implied volatility and in the changing implied volatility and how it relates to Vanna, watching the way that implied volatility is shifting and changing can help you get in front of these kind of Vanna induced feedback loops where when volatility is really spiking or really selling off sharply, that's where the Vanna effect is the strongest, and that's where we can start to assess how the stock may move. Now, this is obviously not something that's confined to just single stocks, even though single stocks oftentimes exhibit a lot more volatility. This is something that often happens in the S&P 500. Under normal scenarios, kind of like we've seen for really the last year, vol is generally drifting down. So in this case, what we did here is we plotted a longer dated, this is a June skew chart, and we plotted the change over about 10 to 15 days. So the gray line is 157 days to expiration, and then the green line is 140 days to expiration. So what you can see here is that over time, vol here is changing and shifting slightly. And the S&P options complex is the biggest options complex in the world, meaning there's more notional value associated with the S&P 500 complex than anything else. And so when vol is shifting, ebbing and flowing in the S&P 500, it is changing the value of puts and calls that have a tremendous amount of hedging flows associated with them. And so when you're talking about Vanna-induced headwinds or tailwinds, it is these subtle shifts of implied volatility, oftentimes they're subtle, that is creating flows that are either supporting or working against the market. Now, how can we get a better example of what this looks like? This is an example of the delta change for a 400 strike put. So with 2 weeks to expiration. So this is an example of a fairly out of the money put. When we posted this chart, we were closer down. We were closer down than we were today. Obviously, the market's rallied substantially the last couple of days. But this is a slightly out of the money put. And what you can see here is all we did again was adjust the implied volatility to see how the delta, i.e. the hedge ratio, would change. So in this case, when we move implied volatility subtly lower, let's say from 20%, which is the blue line, to 10%, you can see how that delta changes. And then when we move implied volatility up substantially, you can see there's a much broader jump in delta, right? It seems to flatten out quite a bit. And the key takeaway here from many of you who are watching this is that this is just representing the amount of delta that has to change, i.e. the amount of hedging flow that has to change simply based on the shifts of implied volatility. So if you're not familiar with watching implied volatility, if you just watch the VIX and you say, oh, the VIX just went from 15 to 20, why does that matter? Well, that may be implying that there's a lot of hedging flow that has to initiate to offset the changes in options values. So that's just a single expiration. If we expand that, at SpotGamma on our dashboard, we have this Vanna model. Now, this Vanna model sounds rather complicated, but the reality is that it's underlying a bit more simple. The gray line here is what we think the rough delta exposure is for the dealer market maker community for all S&P 500 options. So if you look at where we were trading a couple of days ago, the rough delta here would be, call it $26 billion, which is a little bit tough to see probably for you, but that's what this value is here on the y-axis. Now, the higher we go on this y-axis, the more long exposure I have as a dealer or market maker. Why is that? It's because generally what's happening from the dealer and market making community is they are selling puts to people who want to hedge their portfolios. Now, I know today's markets are a little bit different, but stay with me here. So when we sell puts and the market goes down, we're getting fundamentally longer and longer the market if we're a market maker, right? Because a short put will lose value and we need the market to go back up. So if the delta here in the gray line, it is showing us what the equity exposure is if we don't shift implied volatility at all. And you can see there's a gentle curve here, right? So we go from roughly $26 billion of exposure up to $27, $28 billion of exposure. That's great. Now, we all know that if the market was started to drop significantly, that volatility would go up, right? VIX generally really spikes when the market goes up. So what happens if we shift implied volatility? That's what the purple line is telling us. So if we change put values for an increase of implied volatility as the market goes down, then suddenly the equity exposure that we're exposed to as a dealer or market maker jumps significantly, right? It goes from 26, 27 billion up to 30 billion. And this is over roughly a 5% move in the market. So what does that mean? Well, that means for us that volatility is likely to pick up a lot if the market starts to move down and volatility goes up, right? Those two are very closely linked. So as the market goes down, volatility picks up. But then what happens, as we all know, if the market starts to bounce after it's sold off a bunch? It bounces rather violently, right? Now, why is that? It's because vol's coming down as the market's going up. So that delta exposure or the long equity exposure collapses, and all those futures that got sold on the way down have to get bought on the way up. And that is the ebb and flow here as volatility contracts and expands. Now, the same thing happens to the upside, but because generally as we move up in the market, particularly in this current environment, the change in implied volatility is much more muted, right? VIX may go from, 13 to 13 and a half as opposed to going from 20 to 15. And so what happens in those scenarios is oftentimes the hedging flows are more conducive to pinning, meaning that as vol comes down, a little bit of resistance shows up because call values are changing enough that dealers can sell a little bit more futures in the market, and that starts to slow things down. So that's part of the reflexive feedback loop. I realize that some of this is jumping a little bit on you guys and gals, but this is something we're going to be covering a lot more depth in some future presentations. So if we sort of piqued your interest here a little bit, stay with us in future webinars, and we will be covering exactly the SpotGamma framework. What we want to do here is lay out the fact that as implied volatility is shifting, equity exposure or delta hedging requirements is changing a lot simply on the basis of the changes of implied vol. So we mentioned before about how can you tell whether volatility is cheap or rich or expensive, and how can you tell if volatility or Vanna flows are likely to be significantly impactful to the market or not? Well, the starting point for looking at how much or how high volatility should be is by looking at what volatility has been. So we call that realized or historical volatility. This is a chart of 1 month annualized this is a chart of 1 month realized volatility from our site on our dashboard. And what you can see is that we're a little bit higher than when I plotted this chart. We're probably in the 10 or 11 area, but volatility writ large in the market has been coming down, right? Meaning the market is not moving as much as it did in 2022. And we're back to levels that are rivaling really pre-COVID. And so this is important because you can use this metric. You can add 3 to 3.5 points onto it and then realize and see exactly where the VIX should roughly be. So what do I mean by that? Well, if you look at this chart here, it's called variance premium. But all this is doing is it's taking this value here, which is 1 month realized volatility, and it's comparing to the VIX to see what the difference is. And so what you can see here is that generally the VIX is about 3.5 points above what realized volatility is. So the less the market starts to trade, the more future volatility, which is what the VIX is measuring, starts to come down. And Vanna is going to be its lightest, so to speak, we believe, when we're about average on this chart, which is where we are now. If we're up towards the blue line, meaning that there's a big premium to the VIX, or even if we're down below here at the bottom, meaning the VIX is below where realized volatility is trading, that's where we think Vanna flows have its strongest impact. So if you're not a SpotGamma subscriber and you're kind of just trying to figure out how important Vanna flows are, you can simply look at the VIX, subtract about 3.5 points, and that will give you a baseline off of realized vol of how you can get an estimate. For those of you looking at things like our skew metrics and things like that on our charts, you could see where implied volatility has been historically for a given stock like NVIDIA, and that will give you an idea of how important those changes of implied vol are to that stock. Because again, the Vanna flows will matter the most when there should be significant changes to implied volatility. And so if implied volatility is average, or the VIX is average to where it should be, then those Vanna flows are probably going to be a little bit lighter. And lastly, obviously, when you're looking at something like the VIX, I just want to add in this note just to make sure it's just hammered home. The VIX is essentially 1 month S&P implied vol. You could expand on that definition quite a bit. and link it to variance and a bunch of other complicated or more complicated topics. But for the purpose of most of us on here, we could think of the VIX as a gauge of 1 month implied volatility in the S&P 500. And so again, if you look at where 1 month realized is and you add 3.5 points, then you should essentially see where fair value is in the VIX. So right now with the VIX around 13.14, with realized vols around 11, then you'd say the VIX is fairly valued. So Matt, if you're there, I'll be turning the baton back over to you to pick it up from here.
Okay, thanks, Brent. Lots of great questions in the chat. Thank you for being with us, everyone, today. I recognize that Vanna is a complicated concept, especially given the way that the environment hasn't been market up, VIX down, or market down, VIX up. Just want to highlight what we're doing here at SpotGamma is setting you up for what we're running is a volatility challenge week, March the 5th to 8th. So I wanted to give you a special invitation while you're here. Over those 4 intensive days, we will walk you through an in-depth exploration into volatility. So we'll cover Vanna again with more concepts, with more connectivity, what's happening in individual stocks, checklists, so you can get up in the morning and know these are the things I need to cover. This is how to use tools at SpotGamma or other places. This is how I get ready for a trade. So we'll walk through all of that. We'll have really focused efforts around how to track, assess, and trade these different environments. And we'll have global thought leaders on as well to be commenting on what they're seeing in today's markets, in any market, who have been through different paths, whether academic or chief investment officers at hedge funds. Go to the last slide, please. That's just the last part. So again, specifically, it's more than 6 hours of live content. So fully recorded session, just like today. I see a few people asking again in the chat, will we have access to this again? We'll have all of this available later for you. But during that volatility challenge week for $47, you get 4 days of more than 6 hours of live sessions and speaker training. If you sign up for VIP level, you also get access to Q&A breakouts beforehand each day. And at the platinum level, you can ask questions during the Q&A breakout and have that preference. And the following week, we'll have 5 days of live trading sessions with Brent, where you can come back from everything you learned, test theories and ideas, hear from your peers, and get a deeper dive into the world of volatility. It really is what's driving everything nowadays with what's happening, whether you're looking at global wars or oil production or election year. So we really think volatility is driving options, and options are driving stocks, equities, and futures indices. So happy to have you with us today. I look forward to seeing everybody soon. And happy trading out there during this fun season. Thanks, Brent. Thanks, everybody.